the AI capital expenditure boom is probably the largest investment boom of our generation. Companies need to spend about US $5 trillion over the next 5 years to build out the infrastructure that goes along with the AI boom.
Where are you seeing the best opportunities sort of pop up?
Just in the last 1 to 2 months, we've seen $100 billion of corporate bond issuance specifically to fund this artificial intelligence wave.
Yeah, wow. Do you guys have a view on where rates go in 2026?
Look,
Australia's corporate bond market, from sleepy to globally strategic. And this AI CapEx supercycle is about to supercharge things. From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into big outcomes. My name is Ren, and today I am speaking to Anthony Ip, fixed income portfolio manager of the Milford Corporate Bond Plus Fund. This has been a really exciting episode for me and a real education, I guess, in just how big Australia's corporate bond market has become. Because here's the surprising stat. It has absolutely shot up the rankings the last few years. It is now the third largest corporate bond market in the world. And now we add in the AI revolution. Trillions of dollars of investment that looks like it is going to supercharge the corporate bond markets around the world. So to help me get my head around it, I'm turning to Anthony Ip, who's an expert in the corporate bond markets here at home and globally. Now, before we get into it, I want to say a massive thank you to Milford for sponsoring this episode and helping us keep all of our content free here at Basis Points. Milford is Australia's boutique investment firm that works hard for your clients to capture the upside and minimize the downside. Their active management investment philosophy means they keep a close eye on the markets and look beyond current trends. They know in volatile times, capital preservation is as important as delivering long-term risk-adjusted returns. Milford employees invest alongside you. They put their money in the same funds as your clients, so they are just as invested in the outcome as you are. If you'd like to find out more about what Milford can do for your clients, check out milfordasset.com.au. Learn more, and before you invest, be sure to read the Milford Fund's product disclosure statements and target market determinations at milfordasset.com.au. Now, one final reminder before we get into it, every episode of Basis Points is accredited by the FAAA for CPD points. So if you're an advisor, hit the link in the YouTube description or the podcast show notes, complete the quiz, and we will send you a certificate. All right, well, with that said, let's get to my interview with Anthony Ip. Well, Anthony, welcome to Basis Points.
thank you. It's very good being here.
So today we're going to talk about fixed income, and I want to go beyond the standard, RBA inflation yields conversation, although we'll certainly touch on it. But I guess to set the scene, I want to get your view on where we are today. And the RBA met earlier in November. They held rates. What's your take on Australia's macro environment and sort of where we go from here?
Yeah, so I think the Australian economy is fairly resilient. I think there's been a number of things that have gone its way. So, for example, we've had very good amounts of immigration into this country, so that's underpinned demand. We've had fiscal stimulus, so however way you want to characterize that, the size of the public service, tax cuts that we got last year. We've had a number of kind of subsidies for households, especially in power bills and so forth. We've had 3 interest rate cuts already this year. So all of that has kind of combined to support the Australian economy. That's not to say that there isn't, some challenges that the economy faces. I think the Achilles heel really is around the households. So households at the moment, their consumption patterns have been a little bit weaker than usual, although it's improving quite rapidly at the moment. Also, their confidence levels have been pretty low. So if you look at household and consumer confidence, we're still sitting near the bottoms. And that's really a reflection of the fact that over the past few years, we've had a cost of living crisis that households have worked through. We've had negative real wage growth, so inflation outpacing wage growth for some time over the last 5 years. And so really that's kind of holding back households from spending more freely and making large ticket purchases. I think the other thing that the economy is obviously facing as a challenge, you mentioned it as well, inflation. Inflation is still an issue. It's a kind of artifact of what happened in COVID and immediately following COVID. We're still dealing with that kind of inflation wave that has really played out over the last 2 or 3 years. And we saw that in the last kind of CPI print for the September quarter. Inflation came in at about 3% on a core basis, and that's probably uncomfortably high for the RBA. We're also dealing with other challenges. So, for example, unit labor costs and productivity. They're growing at a very, very poor pace at the moment. So as a business, it's very difficult to invest and make long-term decisions when unit labor costs and productivity is so low. And so I think that's something which not just the RBA is grappling with, but policymakers from the federal government down are trying to look at to try and solve. And it's very important as we look out over the next 5, 10, 20 years. It's very important for Australia to solve that productivity issue.
Yeah, it feels like we had that productivity summit. Not sure what policies came out of it. Certainly we spoke about it. Yeah.
Yeah, I mean, it's something that can't be solved in one summit alone. I think it takes coordinated effort from multiple policymakers over many years to solve.
Or we get artificial general intelligence.
That's a huge one, right? That's the question of our generation, really. I think as we sit here, it's impossible to know how this technology will change the way people work. Does it lead to, insane growth in productivity, or does it just lead to job losses and disruption to industries, right? And those two bookends can have vastly different outcomes for the economy.
So I said I didn't want to speak about RBA and rates too long. I've got one more question, then we'll move on to perhaps more less covered ground.
Yep.
But one more question on the RBA and rates. Do you guys have a view on where rates go in 2026?
Look, the RBA's got a tough job ahead of itself. So it's got a dual mandate, right? It wants low and stable inflation, and it wants full employment. So if you look at those two sides of the ledger at the moment, they're kind of heading in diverse directions. And so if you look at inflation, as I said, inflation has been creeping up in the last couple of quarters. We've got core inflation now at about 3%. The RBA has kind of said that some of the uptick in inflation is temporary. And so hopefully some of those temporary factors revert in the next couple of quarters. The way I look at it is some of that inflation components were quite sticky and permanent. So housing and rentals, that takes a long time for it to revert. And that will kind of, hold a bit of a break to the RBA in terms of how much it can cut interest rates from here. If you look at unemployment has gone from kind of high 3s, 4% to 4.5% in the last month's data. And so that's a fairly, it's not a huge tick up, but it's a fairly noticeable one. And the RBA is keenly focused on that. Its view also is that some of this uptick in unemployment will kind of revert in the coming months as well. So I think we're at the point now where the RBA needs a bit more evidence around inflation and where that's heading, and a bit more evidence around unemployment and where that's heading before it can kind of make a decision about what policy and monetary policy and interest rates to put in place. And so I think from here, the RBA is probably on hold for a while until it gets more evidence, which will then inform its next move.
Yeah. It feels like we're in a bit of a wait and see moment.
Absolutely.
Yeah. So you're a fixed income portfolio manager. You manage the Milford Corporate Bond Plus Fund. And as I was researching Australia's corporate bond market, some of the information just blew my mind. So I'm really excited to get into that. And the headline is Australia is the third largest credit market in the world, which I'm still surprised by. So yeah, I guess, can you give us a sense of the history and how we sort of got to this point today? And then we'll dig into what it means.
Yeah, it's a really remarkable evolution, right? So I started my career 20 years ago, and back then the Australian corporate bond market was very small, very liquid, and it was dominated by a handful of issuers, being the major banks who issue bonds to basically allow themselves to grow their loan books and, fund mortgages and so forth. It was so small and, so underdeveloped that actually when I left school, I went to Hong Kong and China instead, straight away after school to get involved in that capital market. And then kind of I observed it from offshore. And over the last 20 years, a lot of changes happened. So if we start with the major one, just the growth of the superannuation industry in Australia, it's become a $3 trillion pool of wealth. And if you look at the breakdown of the assets, what's very interesting is that only 20% of superannuation asset allocations are in fixed income at the moment. So just 20%, right? And 60% roughly is invested in stocks. That's quite a bit of a mismatch. If you compare that 20% fixed income versus 60% stock ratio, if you compare that to the US and Dutch pension systems, it's almost the reverse. So 50% of their assets are invested in fixed income, and a much smaller percentage is invested in stocks.
Yeah, right.
And so if you think about Australia's demographics, where an aging population, a greater number of people will reach retirement age over time, it makes sense for the superannuation industry to have a lot more income generating assets in it and slightly less or significantly less stocks in its asset allocation portfolio.
So you're saying where we've risen a lot and we're third, but that story's still got a lot of playing out to happen.
Yeah, there's an enormous tailwinds from just the asset allocation decisions of the superannuation sector.
Yeah. Has it just been super, or have there been any other factors that have been big drivers of Australia's rise?
Yeah, there's quite a few. So for example, in the last 3 to 4 years especially, we've had a huge influx of offshore investors into our market. So particularly in places like Asia, they're actively increasing their allocations to the local corporate bond market. And these are real money managers, asset managers, hedge funds, even retail investors in Asia are actively deploying into the local corporate bond market. And then the other kind of major pocket of demand that has really made a name for itself in the market in the last couple of years is the Australian retail investor as well. So effectively, these are mums and dads either investing directly in bonds themselves or through advised channels and so forth.
Yeah.
And so they're attracted to the yields that are on offer in the Australian corporate bond market, which are typically anywhere between 3.5% to 5%. And they look at those yields underpinned by very high quality issuers and Australian companies, and they compare that to the other asset classes they could be investing in, whether that's placing money in a term deposit that might be paying, say, 3%, or investing in real estate, which is, in some of the capital cities, the rental yields are in the mid 2% handle, right? And so I think a high quality, steady corporate bond yielding somewhere between 4 to 5% looks fairly attractive in that context.
Yeah, it's fascinating. So I just want to get a sense of the numbers. So we're third. Can you give us how big our market is and then compare us to number 2 and number 1?
Yeah, sure. So if you look at the size of the Australian corporate bond market in terms of the total notional of bonds outstanding, it's roughly around 800 billion Aussie. And if you look at the trajectory, I think, without making too many far-fetched assumptions, we'll cross that $1 trillion mark in the next couple of years. So just take that 800 billion number.
Yep.
If we look at Europe's corporate bond market, depending on how you define it, is roughly around euros 2 trillion. Okay. So if you currency adjust it and make a few adjustments here and there, it's roughly about call it 3 times the size of Australia's bond market. And then the big gorilla in the room is the US, right? So the US corporate bond market is roughly 12 trillion in size in US dollar terms. Yeah. And again, if you currency adjust it, it's about anywhere between 18 to 20 times the size of Australia's market. So look, Australia's market is small in that global context when you compare it to Europe and the US, but it is the third largest market.
Yeah.
And remember, we're just one country, right? If you think about it in that context, Australia is punching far above its weight in terms of the size of the corporate bond market here.
Yeah, it's pretty cool to think. So in terms, you mentioned in the history, back in the day, the corporate bond market was dominated by the big banks.
Yep.
Can you give us a sense of what the corporate bond market looks like today? Like, are there any particular sectors or type of issuers that have really been driving the growth?
Yeah, so I'll step through maybe the big categories of bond issuers in this country. So we mentioned it before, but the banks are still a large part of the bond market here, right? So if you take a company like CBA, Commonwealth Bank, the size of their balance sheet over the last decade has increased roughly by about 50 to 60%. And that growth in their balance sheet, in their loan book, it has to be funded somehow. It's either funded by depositors placing their money with CBA and CBA then lending that money out, or it's funded by the bond market who lend CBA money, and CBA then lends that money out to its customers. And so simply by the fact that the banks have grown by so much in this country and the housing market has been, fairly solid all the way through, that's been responsible for a lot of the growth in the local corporate bond market. The other thing I'd mention is the number of corporates who are issuing into the Australian corporate bond market has just exploded in terms of diversity and types of sectors that are coming to the market. It's just been phenomenal, right? So, for example, utilities and some of those poles and wires and power infrastructure companies, they're investing in renewable energy, to basically meet the green transition. All of those investments have to be funded somehow. If it's not by the banking sector, it's funded by the corporate bond market.
Yeah.
And so we've seen a lot of growth there. We talked about population growth earlier, right? So guys like airports, port operators, hard infrastructure owners, toll roads, all of that stuff, those investments that have been in those areas to kind of meet the population challenges of this country, all of those investments have to be funded somehow.
Yeah.
And the corporate bond market, again, is a significant part of that funding channel. And then I think actually one category of issuer is kind of the most interesting to me is the offshore companies coming to Australia to issue bonds. And that's actually very interesting, right? Because we're talking about large multinational corporates, guys like Nestle, the French banks, the UK banks. They're viewing Australia as essentially the third most viable, most liquid market in the world after the US dollar market, after the euro market. They're looking at Australia as a very, very attractive place to issue bonds and tapping that available pool of liquidity to fund their own operations, whether it's in Australia or globally.
I mean, it's hard not to be proud of Australia a bit. Like, becoming a finance destination for the world is pretty cool. And you mentioned that a lot of Asian investors were, bringing money down, and then a lot of foreign companies issuing. It makes you proud as someone in Australian finance. In terms of, you mentioned a couple of companies there, Nestle, some of the French banks. Are they thinking about it purely because of the liquidity and depth of this market, or are they also thinking about it from like an Aussie dollar point of view as well?
If we take Nestle as an example, they're seasoned issuers in Europe. Everyone knows them in Europe. They can, if they needed to issue a bond at any time in that jurisdiction, they could easily do that at the press of a button. They can also do that in the US dollar market as well. And for them, increasingly, the Australian market has also become that type of market for them, where if they need funding, they literally need to make a decision, and within a week, they can probably get a deal done within the local market here. It's just become that liquid, that deep and diverse a pool of capital for multinationals. I think for them, they have to balance off, the different costs of issuing in Australia. Sometimes it's more competitive to issue here. Sometimes it's more competitive from a funding cost perspective to issue offshore, and they'll make that judgment themselves. But typically speaking, it's a fairly competitive market. Capital flows freely. The funding costs we see here are roughly in line with the markets offshore. And so really just comes down to diversifying their funding base. They need to report to their shareholders in treasuries and make sure that they've got a stable and diverse funding base. And Australia is increasingly a big part of that picture.
Yeah, it's cool. It's cool to hear. So I guess, thinking forward, I was going to ask, how structural or how cyclical this trend is, but I think you kind of alluded to it before with, the structural benefits of the super system and that changing asset mix.
Yeah.
Is there anything else we should be mindful of if we're thinking about this trend and riding this trend and investing in it, in terms of what factors you'll be watching as it develops from here?
Yeah. So we talked about the pool of international investors coming into this market and putting their capital to work in the local corporate bond market here. I think that's a very important point to kind of flesh out, because from the point of view of a global investor, they look at Australia and the macro story actually looks fairly attractive.
Yeah, okay.
Right? So they look at Australia and they see strong and stable institutions. They see a stable government. We've got a two-party political system that is fairly predictable. We've got a AAA rated sovereign government, and we've got a fiscal deficit which is relatively manageable. And I think that last point is kind of an interesting one, because here in Australia we kind of like to discuss the fiscal deficit, and it kind of makes the headlines a lot. But the fiscal deficit here is low single digit percentage points relative to our GDP.
Yeah.
And if you look offshore, if you look in places like Europe, the US, the fiscal deficits are often mid to high single digits as a percentage of GDP. So the fiscal deficit here, I think, viewed from a non-Australian investor, is viewed as actually fairly favorable, very, very manageable. And I think if you put that picture together of strong institutions, AAA rated sovereign, manageable fiscal situation, and then you layer in the fact that a lot of our bond issuers are very, very high quality, household names like Coles, Woolies, port owners, utility companies, it kind of creates this picture of Australia and our fixed income market being a very safe, high-yielding jurisdiction, a safe but high-yielding jurisdiction, and that is a very powerful combination. And so I think, going back to your question, is this kind of cyclical or structural? Parts of it will be cyclical. Hot money will flow across borders when they're trying to seek a return. But I think a lot of the underpinnings of this market and why it's attractive and why it's attracting capital is actually structural.
Yeah. Well, speaking of hot money, that's probably a good segue to a part of the corporate market that I'm sure is capturing a lot of attention and dollars, which is this AI infrastructure build out, because we've spoken about it a lot as an equity story, but more and more it seems to also be a credit and debt story, as a lot of, the big tech players and the like tap debt markets to continue to fund their infrastructure build out. So give us a sense of what it's like on the ground here in Australia, but also globally. How is this AI infrastructure story affecting credit markets?
It's a very topical question.
Yeah.
I'm glad you raised it. So it really depends on who you ask, right? But the AI capital expenditure boom is probably the largest investment boom of our generation. And there was a recent JP Morgan report that came out and said that companies need to spend about $5 trillion over the next 5 years to build out, the infrastructure that goes along with the AI boom. You can pick up consultant reports where that number is not 5 trillion, it's 7 trillion or it's 8 trillion, right? But the simple message is it's a large number. And if you take 5 trillion at face value for a minute, roughly speaking, in some estimates, 30% or roughly 1.5 trillion of that 5 trillion will need to be funded by the corporate bond markets. And so that roughly, over a 5-year time frame, that roughly equals about 300 billion per year. And that's a fairly large amount of issuance to go into one sector. I think for us, the way we think about it, it's a very interesting opportunity because at the end of the day, these are very high quality issuers. We're talking the likes of Google, Meta, Microsoft. These are companies that are going to be around for a very long time, insanely profitable as well. And so there's going to be a lot of opportunities for investors to place capital to work in this sector and generate very good income. And we're starting to see that already, right? So I mentioned $300 billion per year. It was needed to be funded by the corporate bond market to fund the AI investment boom. Just in the last 1 to 2 months, we've seen $100 billion of corporate bond issuance specifically for to fund this artificial intelligence wave.
Yeah, wow.
And so, to my mind, some of these numbers are probably undercooked. There's a lot of upside risk to these numbers, and I think as we kind of go through, more of this over the next 1 or 2 quarters, I wouldn't be surprised if these numbers are ratcheted upwards.
Yeah, it's nuts.
Yeah.
So in terms of the debt that we have seen issued so far, is it all American, or are we seeing it issued across other jurisdictions as well?
Yeah, so we've started to see a significant amount being issued into Europe as well, just in the last few weeks. So it started off as a very US-centric thematic, and that makes sense. These are largely US companies, US hyperscalers building US facilities. But this data center wave is global, right? They're building these facilities across Asia, across Europe, and Australia as well. Yeah. So in the last few weeks, we've seen AI-related issuance in Europe. And honestly, I think it's only a matter of time before some of these companies come to Australia. And again, talking about the deep liquid pools of capital here and the deep-pocketed investors who are active in this market, these big US hyperscalers will at some point in the near future, I think of the Australian market as also a very critical part of their funding picture.
Yeah, surely they're looking at Australia's superannuation industry and they're thinking we need to find a way to tap that.
Absolutely.
Yeah,
absolutely.
Yeah. Is it all the hyperscalers, or are we? Because I guess from the equity side, we're seeing a lot of smaller players sort of pop up. The Australian company Iron comes to mind, but there's a bunch out there. Are we seeing issuers from sort of lower quality companies as well?
Yeah. So outside of the hyperscalers, well, I mean, if you just take a step back, just to construct a data center, you need massive amounts of infrastructure. Whether that's kind of water for cooling, electricity, the power infrastructure, generators, and so forth. All of that has to come along and be built alongside data centers. So in overseas jurisdictions, we're seeing a lot of kind of bond issuance from those sorts of companies who are involved in those sectors, together with the data center constructors and the hyperscalers looking for funding in their respective bond markets. I can see a situation in Australia. We have, a good number of data center construction types of companies. And I think at some point in the near future, in the not too distant future, we'll see things like data center asset-backed securities, for example, in Australia. Yeah. So these are essentially, we've heard of asset-backed securities, basically types of bonds which are collateralized by certain assets, typically, mortgages and auto loans and things like that. I don't think it's a big stretch to see in the next 12 months in Australia, for example, data center asset-backed securities. So asset-backed securities backed by data centers that have already been built or under construction, leased out to these hyperscalers for decades, very high quality contracted cash flows coming into these data centers, into these structures, and then bonds getting issued off the back of that, to finance the data center construction boom.
Yeah. So I guess as a fund manager in this fixed income space, you'd be sort of, licking your lips and thinking about the opportunity and the range of opportunity that's going to come down the pike. How do you approach this with your investor hat on, and where do you sort of think, or where are you seeing the best opportunities sort of pop up?
From a investment point of view, the way I look at it is there's a sector out here, being artificial intelligence and data centers and so forth, that is crying out for capital. It needs capital in order to grow. that often presents very good opportunities for investors because as a custodian of capital, you have a multitude of opportunities and you can be selective and you can, to some extent, dictate some of the terms when you invest in this sector. And so to me, I think there's going to be, over the next, say, 2 to 3 years, there's going to be a lot of opportunities to put money to work in very good structures, backed by or underpinned by leases or, backed by very high quality companies, global hyperscalers who will need funding in order to fund their AI strategy. And to me, as an investor, that's an exciting opportunity.
Yeah. So then I guess the final question, and I guess the biggest risk comes around duration. And on the equity side, there's a lot of chat around, is this an AI bubble? Is this not? Is the scale of spending the right amount? Is it too low? Is it too high? Obviously, when you're thinking on the debt side, these are long duration investments a lot of the time. How do you think about factoring in that duration risk and the questions around, is it a bubble?
Yeah, so very good question. And I think the market is also trying to figure that out as well. So what we've seen in some of the recent deals in the US, taking that as an example, as a lead for our domestic market potentially down the road, is there's a number of factors at play here. Yes, it's designed to be a long duration asset, but this is a new technology, right? And so some of the protections that these structures have in place in the US are quite innovative. For example, I talked about a situation where a data center is being constructed for a company such as Meta. Meta will sign a contract for multiple decades, about 20 years in this example. But what happens, say, 3 or 4 years down the track when this thing is constructed? Meta has kind of decided that it's pivoting away from AI, or its use of AI was a lot less than they predicted several years ago, and they no longer need this data center, and they don't want to rent this data center anymore from the owners. What happens then is, in some of these structures, is that the entity that holds these data centers can then sell the data center, right, at market price at the time. And if there's a shortfall in the data center's value relative to the amount of debt outstanding backing these securities, the hyperscaler, Meta in this example, will guarantee the residual value, that's residual value gap.
Yeah.
And so the market has come a long way, but you can tell that they're thinking through these structures. They're thinking about, putting in place long multi-decade rental contracts. They're thinking about residual value. They're thinking about what happens if the market value of these assets change over time and they're not as valuable as once thought. And we could talk about this for hours and hours, but they go through, what happens in a natural disaster. What happens if a cyclone or an earthquake wipes out some of these data centers?
Yeah.
There's contingencies around that as well. And so the point here I'm trying to make is that, yes, these are very long duration types of assets. And this is a new technology, things can go many different ways, but there's a lot of contingencies that have been kind of managed for. And so I think for a credit investor, you really need to work your way through these structures and make sure you're covering all your bases and all of the risks that can occur over a multi-decade period.
Yeah, it's interesting, isn't it? Like that structure is great, and it kind of leans on the creditworthiness and the balance sheet of some of these hyperscalers. But then when you're looking at these hyperscalers, you have to also think that not only you look at the debt that they've issued, but you also have to think about the debt that they've essentially guaranteed to the data center operators. Yeah.
2 or 3 years ago, these hyperscalers, they had a lot of cash. They were generating even more cash every single year. And now it's changing, right? They're using up that cash as part of this investment wave, and a lot of their cash that they generate in the business is being plowed into artificial intelligence and so forth. And so the nature of their balance sheets is changing.
Yeah.
But at the end of the day, They're future-proofing themselves. My personal belief is that this artificial intelligence investment wave will generate revenues over time. And to me, there are signs of, you used the word bubble before. There are signs of that. There's frothy market valuations. But the way I see it is, if you look at these data centers that are coming online today, they're being fully utilized on day one, right?
Yeah.
It's a bit different to kind of if you go back to the dot-com bubble, where companies were being created and valued at ridiculous valuations without a cent of revenue to their name. It's a lot different to that situation, and I think we just need to keep that in mind.
Yeah, I saw a clip. I think someone from A16Z was talking about it, how in the 2000s build up, there was huge amounts of fiber optic cable laid, and then over 90% of it wasn't used. It was all for the future.
Yep.
Whereas every data center and every GPU that's put in is being used.
Yeah.
So that is a key difference.
Yeah, absolutely.
Yeah. So look, we are running short on time, and I want to bring this conversation together and really give some of the advisors listening some practical takeaways. So, I guess to go back to that conversation about Australia's rise as a destination for corporate bonds, how should that change how advisors think about this market and approach it from an investment sense?
The key message here is that Australia's fixed income market, and specifically its corporate bond market, is no longer an obscure part of the market, right? So in the last 2 decades, it's gone from this niche corner of the local capital market into something that's very globally relevant. And I think that's probably the key takeaway that I'd put forward today. And with a global and deep and diverse market such as the corporate bond market here, there's a lot of different opportunities and a lot of investor needs that can be met. So if you're for example, if you're an advisor who's seeking predictable, stable income for your client, the Australian market can certainly meet that requirement. If you're looking for a bit more bang for your buck, higher income, willing to stomach a bit more volatility, there's a part of the Australian bond market that can suit that as well. I think one thing to keep in mind is that the Australian corporate bond market has grown to enough size that it can become a strategic, permanent part of investors' portfolios. One key advantage of this asset class is that during periods of an economic downturn, usually interest rates ratchet downwards. And when interest rates ratchet downwards, that usually leads to capital gains for investors in fixed income. If you compare that to what happens to stocks, typically, when the economy slows, earnings growth slows, typically stock valuations drop, and they can drop significantly. But in the fixed income situation, typically you see capital gains as interest rates come down. So as a strategic asset allocation, it makes a lot of sense. It acts as a high quality portfolio stabilizer that also generates attractive income on the side.
And I guess to follow on from that, are there any parts of the capital structure or particular sectors that you think are showing opportunity in Australia right now?
Yeah, so look, the outlook is a little bit uncertain at the moment, so we prefer to stay up in quality. So just building a core portfolio of very high quality, high grade bonds backed by high quality issuers that we think can weather economic storms with ease. So that's kind of our core investment strategy at the moment. We like a lot of the high grade single A corporates that issue bonds right now in that 4 to 6 year maturity. Typically you're getting bond yields about 4 to 4.5%. And that's a fairly good risk-adjusted return. If you hold that to maturity, I think that's a fairly good risk-adjusted return for investors. Another part of the capital structure or part of the market that we're spending some time on is the corporate hybrid market. So corporate hybrids, just as background, is a debt instrument that's issued by companies to support their balance sheets. So it typically sits senior to common equity, but junior to senior creditors and bank creditors. So it's a bit of a hybrid of debt and equity, hence the name corporate hybrids. And they're issued by companies that are looking for a bit of balance sheet support as they go through a large investment phase. And there's a lot of companies in Australia that fit that criteria. And as a result, the number of outstanding bonds that are corporate hybrids has really ballooned in the last couple of years. So if you just take a step back, these are corporate hybrids. There's a bit more structural risk, as I said. They sit junior to senior creditors, but you're getting paid a significantly more amount of income to hold that security. And also these securities are issued by very high quality companies as well. So to me, you're taking on a bit more structural risk, but at the end of the day, they're high quality companies and you're getting paid more to do that. And I think that's an interesting area for us.
Yeah, it is interesting. And I think for people who are a bit getting confused by that, the listed bank hybrids are being phased out, but this corporate hybrid market seems to just be growing.
Yeah, it's a very important point to make.
Yeah.
The listed bank hybrid market is being phased out by the regulator, and some of that capital is finding its way into the corporate hybrid market. They are somewhat similar instruments, and they're also issued by very high quality companies themselves. So it's an important part of that overall income investment universe for Australia's investment public.
Now, Anthony, I want to close out by a bit of a quick fire game. So I've got 4 points and I want you to finish the sentence for me, all right? So first one, the biggest myth in the fixed income market right now is?
The biggest myth is that you can only make money when interest rates fall. Income and the coupon and the yield on these instruments is a large and important component of the total return of these investments.
Nice. The most misunderstood part of the Aussie credit market is?
I guess it's depth. You'd be surprised at how institutionalized and how sophisticated the market has become here.
For bond investors, AI will be?
AI will be a multi-decade funding story. The picks and shovels of this industry will need to be funded somehow, and I think the corporate bond market will be a large part of that funding picture.
And then finally, if I was running an advice practice, I would
treat fixed income as a strategic allocation and not just a tactical allocation of any investment portfolio. It's a quietly compounding part of any diversified portfolio out there.
I love it. Well, Anthony, we really appreciate you coming on today and sharing your insights. Thanks for joining us on Basis Points.
Thank you.